Hi everyone, this is Colin Tierney at Sageworks. I work in the marketing group here and I will be introducing today's speaker and doing a couple housekeeping items here at the beginning of the presentation before we dive in. So you should all see my screen at this point, and I'll just go ahead and go through a couple slides and then we'll turn it over to our speaker today. Okay, so if you have questions, there is a question box in the GoToWebinar panel. You can ask questions at any point. I'll take a look and do my best to answer them. If you also have questions for the presenter, we can have a Q&A at the end of the session today as time allows. So if you have questions at any point for Katie, who will be presenting today, we'll make sure that we try to leave time to answer those. You can ask them at any point during the presentation. There's also in the handout section a copy of today's slides as well as some information about us, so you can take a look at that there. I'm not going to spend much time talking about Sageworks today. I will mention briefly just a couple products that we offer. These are web-based technology solutions for people who are advising small to medium-sized businesses, such as CPAs or other business advisors, as well as people doing business valuation following the AICPA SSVS1 guidelines. If you're not familiar with Sageworks, we were founded in 1998, launched our first product, ProfitSense, which is our flagship product in the business advisory market. That was in early 2000s, so we've had that product now for about 15, 16 years and has been a tremendous force for us here at Sageworks and also helped many thousands of accounting firms with their advisory services as they look to expand and grow and differentiate and attract high-quality clients that they can help to generate more business for those clients. So ProfitSense enables you to benchmark and look at financial data and insights about the business to improve your client's financial performance. We do have to provide a legal statement in all of our presentations. This is not specific to today's content. You can read the entire statement in the handout section. It's basically saying that anytime we make forward-looking statements, of course, we cannot predict the future, so you have to take that in context. I'll spend a moment here introducing Katie Tolan. Katie and I have worked together on a couple webinars in the past, and we've had her at a couple of events. We also have her speaking at an event coming up with Sageworks here in early August in Raleigh. So if you're looking to learn more about advisory services, you can see her live presenting here in Raleigh. It'll be a smallish group, around 50 people, so it would be a pretty intimate setting where you get to learn about advisory and improve your business and practice, and also think about how to either generate higher profitability for what you're doing or cross-sell clients and all the different facets of having a really top-notch advisory practice and helping your clients improve financially. So Katie is a tremendous resource. She's been in the industry for a while and has seen all sorts of different sides of it, a lot of experience on the marketing side as well as cross-selling, and we'll talk today about firms building and managing sales pipelines. So it's really she's a tremendous resource, and we so much appreciate having her here. I am now going to turn the presentation over to Katie, and she will go through her slides with you.
All right, thank you so much, Colin. I appreciate the introduction. So now we'll get into the part of the presentation today that's on your pipeline. You know, top-line growth is important to probably every firm out there today. Who doesn't want to grow after all? However, a lot of times growth is haphazard. You probably know that someone in your firm right now is going out and getting work. They have some leads they're pursuing. But you don't really know what they're chasing, and you don't know what sort of success they're having. And you probably don't even know if you're chasing enough work right now to really hit the growth goals you've set. So this afternoon, I'm going to talk through the logistics of pipeline development and how do you talk about this in the proposal process, and where does that kind of fit in to increase your odds of winning. I'm sure all of you have a different baseline of understanding as to what a pipeline is, so I'm going to start off with some foundational information to ensure that we're all on the same page. And later in the presentation, if those of you who are already running pipelines, I'm going to share some advanced concepts so you can really take what you're doing to the next level. So let's start with what is a pipeline. You know, a pipeline is how you measure how many potential buyers you have. So think of it as like an inventory of sorts of all the leads within your organization. It requires that you assign each of your prospects a stage in the decision-making process. And each stage moves you one step closer to either winning or losing an opportunity. You know, a pipeline is where you capture the sales information. So it can be in a document as simple as Excel, and I'll show you a sample of that later. It could also be in data that is in spit out in a report format from a database like CRM, which is Client Relationship Management Software. And today there's technology out there as well that are that really help you manage solely just your pipeline. So there are different formats that your pipeline can take, but really it's where all this information is housed. And really when you look at this information, you know how much money you could potentially bring in based on the number of leads that you close. And you know, as you track it and go through, you really understand then what are your odds of winning a certain opportunity that lands onto your pipeline. You know, there are different types of pipelines. I've seen pipelines by partners, niche teams, and if you happen to be from a multi-office firm, I've seen pipelines by office. I think there's tremendous power in a firm-wide pipeline. To make this manageable, though, you really have to put a minimum dollar threshold on it. You know, if you think about it, and we all have those individual tax returns that come through, like what value do we have by tracking every $500, $600, $800 tax return that comes in? But when it comes to setting a minimum dollar threshold for your pipeline, it has to be what makes sense for your firm. You know, it could be that you really want to include any opportunity that is $2,000 or more. Now, if your firm's a little bit larger and you track a different type of business, that 2,000 could really be 20,000. So there's not a set number, beside it needs to make sense for your clients and the type of work that you pursue. What happens when you have opportunities below that threshold? You can put them on another pipeline, you know, if you want to track it that way. But you really need to keep the number of leads on your pipeline manageable. And that's so you can actually do something with the leads. That means somebody's actively looking at your leads, you're discussing next steps, and you're really trying to increase your odds of winning. You know, a pipeline does no good if it sits stagnant and it just sits there and collects dust. You know, you really need to use it to manage the growth of your business. So the pipeline is how you ensure that people in your organization are doing what you need them to do to increase your win rate. You know, if you don't manage the pipeline, you know, the document itself doesn't do anything for you, and it's probably not even worth your effort to put it together. You know, here's a quote that somebody shared with me a few years ago from a sales training company, and I really like this. You know, a pipeline doesn't do much if it's not filled with the right opportunities for your firm. You know, you could put all kinds of businesses on your pipeline, but there are certain businesses that you can serve better and that you can provide more value to, and those are the leads that you want. Once you have a lead, you also have to make sure it's the right people working on it. The person who obtained the lead may not be the best person to pursue it or to even service it if you happen to win it. That's why you have to assemble winning teams as you're pursuing an opportunity. And all these people have to be taking the right steps in the sales process. It's sort of methodical in terms of once you do this, here's what next looks like. You know, no two sales are completely the same, though. You really have multiple strategies that you can rely on in different situations. When you get a lead and you win it, it really shouldn't be a happy accident for your firm. It should be because you've taken a coordinated effort to actually win that opportunity. Now, how do you manage these pipelines? You actually manage them in what I'm going to call a pipeline review meeting. So you review your pipeline, I would say every 2 to 3 weeks. I think 2 weeks is best. You know, I have done it at 3 weeks interval, but sometimes leads really come in and they close in a short period of time, and within that 3 weeks, you could have an opportunity, and it could result in a win or loss really quickly. So I think 2 weeks is good. Your meetings can be done in person. If you happen to be a one-office firm, that's great. That makes a lot of sense. You can also do it via phone or video conferencing, how you communicate amongst the group of the partner group. I would say calls should be anywhere between 20 and 30 minutes. If you're have a smaller number of leads on your pipeline, you could probably do it in 20 minutes. Even the largest firms that have a tremendous number of leads on their pipeline probably shouldn't go beyond 30 minutes. I think that's, you begin to lose people's attention after that. And these calls are really to talk about your opportunities on your pipeline. You really want to keep it to that focus. That really helps demonstrate the value of the meeting, and then people are going to show up. Now, when you're talking about who should be involved in these meetings, minimally it needs to be any partner in your organization. You might want to consider managers too, especially any managers that are trying to generate business, but also those that you want to see that getting new work is part of their job and something that they're going to be involved in the process. If you do let people in the pipeline meeting beyond the partner group, though, make sure you have some level of protection, either in a manager agreement, maybe it's in your employee handbook even, but something that, basically tells people they're not allowed to share your intellectual property. If this data was to make it in the hands of your competitor, it could hurt you in terms of your opportunity to win those leads on that pipeline. I also think that these meetings need to be mandatory, and it needs to come from the top down. The managing partner needs to say, we are doing these meetings. They're taking place every second Thursday or every 2 Thursdays. We're doing them at noon exactly. Maybe it's at 7:30 a.m., whatever time works for you. And you should schedule your other meetings around it. And even if you're on the road, sometimes you're on the road traveling to or from meetings, we want you to call in and join us. It's that important to our organization that you be here and be part of those meetings. And what happens is, on the call, is the managing partner brings up a lead. So they say ABC company. And the person pursuing it talks about where we're at in the process, what we know about this lead, and what we're going to do next. Everyone who's participating on the call should be encouraged to jump in. Perhaps they have a connection with that company. They want to make sure that they share those connections. But also, did they have a similar pursuit? Did they go after a similar company? What did we learn from the past that we can reapply in these current situations to increase our odds of winning? As you're looking at all the leads on the pipeline, I like noting those that are new, because those are great ones to talk about. Also, anyone that maybe had activity since your last call. So, you went out and met with somebody and you've moved stuff a step further. Those are great ones to talk about. And then nobody wants to, but there's going to be these leads on your pipeline that sit there for a while, and maybe they've been there 3, 4, 5, 6 months. Those are great ones to talk about as well, because a pipeline is your active leads. So if there's something on the pipeline that hasn't been touched in 6 months, how active really are you at pursuing those leads? Most firms don't get through every lead on their pipeline. So that's why you can mix it up and make sure you're talking about some of the most strategic ones. Hopefully you get to them all at some point in time, but I think the new ones are always a great place to start. So why do you do this? You're probably looking at this going, oh my gosh, I have to have a document. Now you're telling me I need to have a couple meetings. This begins to get a little overwhelming. Well, when you review your pipeline on a regular basis, it helps formalize your sales process. It reinforces to the people on your team that we have a process and we want to follow it, because that's what gets us our best odds of winning. The fact that you are dedicating time to these meetings, and they're recurring meetings, shows how seriously you are taking business development and taking the growth of your organization. Also, these meetings, because everyone's involved, is how you really pursue a team effort. Think of this as a game of football where people are coming together, and not a game of tennis where you go out and play on your own. We really want to get people working together. And it's also about the buyer and what they need, and not typically what we want or what And when you come together, you can come up with ideas on how do you actually demonstrate that to your prospect. A great thing to do in the pipeline as well is to celebrate your wins, celebrate your successes. This really creates momentum. People want to win. They want to have the next win so they could celebrate. When I was in a firm once, we had a bell, and the bell is what we rang to celebrate a win. I've also heard of kazoos and maybe playing an audio file of applause. A few years back, I actually heard of one firm that actually had a gong in their lobby, and when they had a big win, they actually went and hung and hit the gong. Really, how you celebrate is limited by your creativity, but make sure you celebrate those successes. And as you're looking for connections between your prospects and other people in your firm and sharing best practices, you're learning from one another, and you're advancing the knowledge and the skill set of everyone on the team. And really, this is what's going to allow the next person to have a better odds of winning that opportunity. And all of this really comes together to help you drive the top line revenue of your organization. So why would your firm have a pipeline process and take the time to put stuff on a document? Well, think of it this way. Every lead that comes into your firm is an asset to your organization. So you would not let anyone in your firm mismanage a $50,000 asset like a piece of technology or a new piece of software. Why would you let them mismanage $50,000 in potential dollars to your firm? When you put a lead on the pipeline and you land it, you're managing that asset to make sure that it's being properly handled since this is potential dollars to your organization. You know, there are also people in the firm who get leads and they run with it. You know, they never even ask themselves, am I the person that should be pursuing this? They don't get advice from others. You know, whoever in your firm is responsible for sales management, and I would highly advocate that that be your managing partner, would take on that function, should be the one that's helping coordinate the teams and encouraging people to really share and work with one another. And then selling is never a one and done process. You always have to think about the next step. And when you have a pipeline, that's what you talk about. You don't show up in a pipeline and say, well, I went and met with Joe last week and we had a conversation about whatever it is. That's great. That's the history. Thanks for sharing. But what are you going to do with Joe now? Or is it Joe? Do you go meet with somebody else? So the pipeline process keeps you focused on what that next step should be. I think it also adds a level of accountability. Is someone really working the lead? You know, if they put this lead on the pipeline, what are they doing with it? Are they taking steps to advance the lead in the sales process? Did somebody say they were going to? Did somebody do what they said they were going to do? So if their next step was they were going to call Joe on Tuesday and ask to go out and have a meeting, did they call Joe on Tuesday and ask to go out and have a meeting? This is how you begin to hold people accountable in the sales process. You use the pipeline to sell next steps. And let's look at why sales is not really a one and done process. What you're looking at here are some very common sales statistics that are very predominant in the sales profession. I really want to call your attention to the bottom half of that list. Many people are incredibly surprised to hear that only 2% of sales are closed on the first contact. 2% of all sales are closed after the first contact. Now, you know, it's very uncommon that you can have an interaction with somebody and then turn around and send them a proposal. That's not really how it goes. Now, recognize I did say contact. So a contact is not necessarily a face-to-face meeting. You know, you can contact people these days via phone. It could be via email exchange. It could be a Skype conversation. It can even be conversations via social media. The most important statistic on here, though, that I really want to draw your attention to is that one at the very bottom, where 80% of all sales take somewhere between 5 and 12 contacts before they're closed. That's a lot of next step selling that you're doing. You know, how do you make a reason to contact the prospect again in a meaningful way? You know, it takes time to build rapport with somebody. to uncover the unique issues that they face. Because sometimes the issues that they tell you up front are not the real issues when you dig a little deeper. And it takes time to actually strategize about how we can come in and best help this prospect solve the issues that they face. You want to continue to have these contacts with your prospects until you know or you feel pretty good that you're going to win this opportunity. And only at that point in time do you submit a proposal. As soon as you send in a proposal, the sales process is over. And virtually every situation is hard to sell after that's done. Any contact you would have with a prospect after the proposal usually doesn't sway the decision. There are exceptions, but for the most part, it does not sway someone's decision. So the key is, you got to have these 5 to 12 contacts, and your pipeline helps you push those next steps forward so you get closer to that win. So Colin, we've come to our first poll question. If you could launch it for us, please.
Okay, that poll question will be up for about 20 more seconds. All right, I'm now going to close the poll question, so please vote if you haven't already. Okay, the question is now closed.
All right, thank you, Colin. So let's jump back into the presentation. What I want to look at now is the actual proposal documents. Even if you keep them in a database and you're using software or CRM to do this, they all have reporting functions that they spit out the report. So your reports might look a little different, but I really just kind of want to walk you through these documents and what it is that they look like. When you have something on a pipeline, it needs to be tied to a stage. And a stage needs to be a step that matches your sales process. Usually I've seen sales processes anywhere between 3 stages. I've seen some as high as 8. I've heard as high as 12. I think that starts getting a little crazy. I think you can do this in as simple as 4 stages. On my pipelines in the past, I've always used unqualified, qualified, proposal, and final. So what an unqualified lead is it's one of those businesses that you'd like to work with. Or maybe it's a referral that just came into your organization. At this stage, you really don't know much about them, but you want to actively find out more. So from there, after you put somebody on a pipeline, a lead can come on the pipeline at any given point in time. Most often, though, they go from unqualified and then move up to qualified and then proposal and final. Something moves to qualified once you know and can confirm that there is an immediate need for what it is that you offer, but also that they have the money to pay you. There has to be enough pain going on for this client that's driving a change in provider, or maybe it's requiring a need for this advisory service that you offer. And if that need's not there and they don't have the money to pay you, then it's really not a qualified lead. From there, you go into the proposal stage. And this is where you said, okay, we've learned about this lead, we want to bid, and we're in the process of pulling a proposal together. Once you submit a proposal and you're really waiting for that response back from the client, whatever their decision-making process looks like, is when a lead sits in the final stage. Now notice in there I have this category called inactive. I wouldn't really call this a stage of the sales process. I guess it could. But to me, this is when you have a lead on your pipeline that really doesn't advance, and it's going to come back at some point in time. So I've seen this a lot when a client was thinking about doing a specific project, and so they would need our help in some capacity on this project. And then they decided, well, we're not going to do this project right now, but we're going to do it later. So you would move that lead down to inactive because the opportunity is going to come back. Or maybe you've been talking to a prospect and they're saying that, this is the year they're going to go out and bid. We finally have had it with our current provider. We're going out to bid. And then they come back and say, you know what, we're now being audited by the IRS. We decided this is not the time to go out to bid, but we're hoping to do it next year. So once again, you can move that back to inactive because it's going to come back next year as an opportunity for you. If you actually submit a proposal, though, and you get a no, but we're happy to let you bid again next time, that doesn't mean it goes to inactive. You need to mark that opportunity as a loss, and then when the opportunity comes back to you, go ahead and put it on the pipeline again. So once, if you actually get a yes or a no, then it moves off this to a win-loss report, and I'll cover what that looks like here in a minute. So let's take a look at the information that you should really have on your pipeline. I've divided this into two categories. On the left is the basics. I think this is the minimum that you need to have on your pipeline. On the right are the additional and beneficial. And that may make sense based on what your firm looks like. Under the basics, I think these are pretty easy for us all to understand. Let me just point a few out, though. You need to put an estimated revenue on your pipeline. When you first encounter a prospect, I get the fact that you might not have a clue about what that amount will be. So put one. It doesn't have to be set in stone. This number can be updated on the pipeline when you get a better idea of what it is. I always said if there's a minimum for your pipeline, let's say you come back and say, our pipeline is only $5,000 in leads or more, put it in at $5,000. It can move up from there, as you know, as you learn more about the client. The other thing worth noting is the next step. Remember, you have to have at least 5 contacts before you close a sale. And this really gets to the heart of what those steps are. You know, you decide what it is you're going to do next. You're going to document it on your pipeline. So, you know, Joe is going to go out and meet with the CFO by Thursday. And this is, you know, how you add that accountability because it's in the document. Under the additional sides of things, industry is probably a requirement if you go to market by industry. I also really like type of work. So for example, is this a new project for a current client, or is this a new client and it's going to be recurring work? This really helps you determine how much of your work is project-based and how much needs to be replaced in a year if you're going to continue to grow. I also really like the date added, updated, and how it moves from stage to the other. If you're going to do some future analysis of your pipeline and begin to predict your revenue, which I'll touch upon here in a minute, those are going to be very instrumental pieces of data for you to have. So let's look at a pipeline. So remember, this is all of your leads at any given point in time. And really, every lead should be on here. So make sure that you push and you challenge and you twist arms and you use a carrot or a stick or whatever it is to make sure that your people are putting every lead on here. Now, this is an overly simplified version of a pipeline, so it could fit on this slide. You know, once you decide what information you need to include on your pipeline, you know, yours is probably going to look a little bit different. But I just want to hit upon a few of the key calculations. I have formulas in here for those of you who want to tackle this later. But first, you want to know how many total dollars are on the pipeline. So this is a simple, you know, added up kind of number. Next is how many opportunities you have on the pipeline. It's a simple count of how many there are. You then get to the average transaction size. So this is the average revenue per prospect. This is valuable if you happen to know what your average client size is, because on your pipeline, you really want to target those size clients or more. Now, this here is the percent of firm revenue that is represented on the pipeline. Salespeople often throw out that you should have 10% of your current revenue on your pipeline if you want to grow. I have searched and really tried to figure out how they came up with this 10% number, and I can't find it. When you kind of backtrack yourself into it, you know, if you think about the price increases that you have, whatever your lost client turnover is, and the fact that you don't win every opportunity, if you get this at 10%, you're going to at least end up with you know, single-digit growth, 5, 6%, 7% growth. If your firm wants to grow by more than that, then you need to have more than 10% of your revenue in your pipeline. You also want to do some calculations by stage, like how many opportunities do you have in each stage, and then how many dollars each of those represent. Once something hits your pipeline and is either a win or a loss, it comes off the pipeline and goes to a win-loss report. you want to know both the total opportunities that were won and the dollars that were won. And as you improve your process and you improve your sales skills, you'll really see these numbers beginning to move up. So what you want to do is you want to count up the number of wins that you have and know how many dollars that represents. And then you want to calculate the percentage of the opportunities won as well as the percentage of the dollars won. If you aren't chasing every lead that comes in the door and you're really only bidding on those qualified leads, then your win rate for both of those is really going to be in that 60 to 70% range. I've seen some firms get above 70% if they're really strategic about who they go after. On the flip side, if you do a lot of nonprofit work or government work, then this number could be lower. You get involved in a lot of those RFP situations and you bid even though you didn't get to meet the decision maker and you're not sure it's fully qualified, and that really skews your numbers down. Also, nearly every firm that I've talked to about their rates in these two categories have seen the total number of opportunities be higher than the total number of dollars. And when you think about that, the bigger opportunities are few and far between and more people probably bid on them. So don't be alarmed if one is a little bit higher, but the 60 to 70% range is where you should be targeting for both. This document's also chock full of other information, like who's referring them. So if you put on there, who's their current or who was this referred by, where are they coming from? Is somebody good and only referring you the hit them out of the ballpark ones? Is there somebody that's only referring you the losers? Because maybe you can have a conversation with them about what really you're looking for. Where are you coming? Is your work coming from? Is it a certain industry? Is it a service? Is it a location? And are there certain people or industries or an office or whatever it is that actually wins or loses more than others? I encourage you to keep a running tally of all your pipeline and your win-loss report statistics. So this is a simple document that looks at, how many leads and how many dollars were in the pipeline during set intervals. So in my case, it was every 2 weeks. So every 2 weeks, how much was in the pipeline at the various stages. It's a great visual to help you begin to spot trends. Also from here, you can begin to benchmark. So maybe at this time last year, you had $1.5 million in wins, but this year you only have, $750,000 in wins. This gives you some insight as to how your year may turn out. And this sort of record is going to help you with deeper analysis that I'll get here to in a second. When you consider analyzing your pipeline, there are other ways you can dig into here. So maybe you want to look at the opportunities by partner or office or by niche. Then you can really see who's controlling the growth. If you can do it by service, that would be great. One thing that I found, though, is we really tried to encourage people, if they had like ABC client and were bidding on both the audit and the tax return, to put them on the pipeline as ABC client audit for X dollars and ABC company tax return for X dollars. And what we found out, though, is those tax returns were often below the dollar threshold, so we did combine them. But if you have any data in your pipeline that lets you look at it by a service perspective, that can be very beneficial as well. If you look at how long something stays on the pipeline, you better understand what you have a chance of winning in a certain period of time, like this fiscal year. And if you know what type of work is on the pipeline, like how much of it is project work, you better understand what that is that's coming up. I've heard of firms that actually use this to start planning future work. So we just won this opportunity. It's X hours of work, and it's going to start in July. So let's take a look at how I broke this down. So this is just one example of the different breakdown categories. And what I did is decided to look at it by industry. So what we did here is, we looked at how many leads were on the pipeline. Then we looked at, what are the number of wins, and then we added those up. Then you really want to calculate what they are. So we've got the win rate for the dollars and the win rate for the opportunities. And what this is this shows you in this example that medical is what's driving all of the wins on your pipeline today. So where is your business coming from? It's coming from the medical arena. And that would be the same in terms of the opportunity, the dollar size. So then you go over and also look at it, what's their individual win-loss rate? So there's the loss side of it as well. Once again, what is the percent of the opportunities won for that specific niche? And what is the percent of the opportunities lost for that niche? And here's why I did this exercise. Is there a certain industry that's performing better than the firm average? You know, for example, medical, 46% seems pretty high. What are they doing? Are they doing something that we can copy elsewhere? You can also then work to improve individual rates. You know, if you've got your government that you're only winning 42% of your opportunities, then how do you actually move that up? And then hopefully if you decide to go to market via industry, and these are the 3 industries that you're targeting, hopefully those are the 3 that are actually represented in this scenario. You know, depending on what your pipeline captures, you could even delve deeper. I did this in one instance and looked at it by partner. I really wanted to see, you know, I suspected who the rainmakers were, but there were a few surprises when you looked at it, that who had a really high win rate, which just showed me that they were being very strategic about who it was they were chasing. So when you begin to make predictions on your data, you have to have a history. So you want to know when things went on the pipeline, and you know, another one that was key is when they moved from qualified stage to proposal stage. To make this easier, save off your pipeline reports. Even if you pull them from CRM, save them and say, this is today's date, and then save your next one 2 weeks or 3 weeks later. Even if you're not ready to make predictions now, you're going to then have the data to do it later. When you do these predictions, there's a few things that you can accomplish. You know, once you know how long something's on the pipeline, you know when you're going to win it. You know, it's great if you have $5 million on your pipeline. How much of that $5 million are you going to win? But more importantly, how many are you going to win yet this fiscal year? Then you want to look at how close you are to goals. So maybe you have revenue goals, and this pipeline is going to tell you how close you are to hitting those goals. And my favorite part is you begin to forecast your future revenue. So a lot of times when firms put budgets together, they go out and they ask the partners and say, hey, we're doing our forecast for next year. How much new business are you going to bring in? And that's how they do them. I've actually used the pipeline to predict similar information, and I ended up actually coming up closer than what the partners themselves predicted they would do. So here, and I don't have all the formulas and stuff built in here for this because you have to make assumptions. And the formulas become very complex when you begin to make some assumptions in data analysis. And no 2 firms is going to make the same assumption, but recognize I just want to get to the gist of what it is that you're doing. So this data that you're looking at now is pretty much is what comes from the pipeline. We did share this with our partners, but I actually found it easier if we looked at data in the form of pictures. So for example, this chart looks at the dollar performance and your opportunity performance. The key here is you want to factor in those opportunities that go inactive. So we would really like to believe something comes on the pipeline, it goes all the way through, it's either a win or loss. But some of those drop off, so you need to be able to factor that in as well. How long does it take to make a decision? This really gets to the heart for how quickly something could result in a win. One thing that I have found is the longer that it takes to make a decision, the less likely you are that's going to win anything. Then this really just gets to the heart of what your goals are, and you know, how close are we to actually hitting those goals? And then, you know, what does our pipeline look like? So if we're going to hit our goals, and here's what we have in our pipeline, how much do we need to add so we can get back? What I found is this really help people set better goals. You sit back in your office and say, oh, I'm going to grow by 7% this year, but you really don't know what that takes. And going through an exercise like this actually tells you what that 7% is going to equal in terms of what you have to have on the pipeline at any point in time. So now we've come up to our next poll question, so I'll turn it back over to Colin.
Poll question is now live. I'll leave that open for about 20 more seconds. Okay, just 5 more seconds. I'm now going to close the poll question.
All right, thanks. Let's jump into a few obstacles that I just want to hit upon briefly that that you might face. We already talked about people not adding leads to the pipeline. Also, people like to not update information. Anything you can do to make it easier for them to get the information updated, you know, is technology, is a CRM or something like that the solution? Or is it assigning an administrative person in your firm to actually sit down with them and get those updates? So that will be an obstacle that you have to do. Also, after you do this for a while, the format really gets stale. So that's when you have to mix it up. So I've seen things like, well, this week we're going to have Office A report all their leads, and on our next call we're going to have Office B do it. Find different ways to talk about leads so that everyone ends up getting a voice. Even those people that don't have as many leads, at some point in time get to talk about what it is that they're working on. Also, don't go over. If you set your pipeline for 30 minutes, people are getting testy at 35. So stick to it. Make sure that you ending a couple minutes early is actually great. Also, what drives me crazy is when you're on these pipeline review meetings and you're like, great, would you like to tell me how your conversation with Sally went? Oh, I'm waiting for a response from her. If you're waiting for a response, you're not leading the opportunity and there's no action. So really make sure that there's action on your pipeline, and waiting for a response, don't accept that as an acceptable answer. And then, you know, also the items that don't move. You know, somebody puts them on the pipeline and then I don't know what happens to them, but they never really come back to them. So make sure you're following those items that don't move to figure out if they're being worked on. If not, they shouldn't be on the pipeline at all. So a couple tips, audit when you can. We talked about that briefly. Make sure the stages on your pipeline match your sales steps. So if anyone has had sales training, make sure you match them. If you haven't had sales training, there's lots of online resources about sales steps that can be beneficial, or use ones that I've shared. Push for the next steps. All I like is set goals for your pipeline and communicate them. So I talked about having at least 10% of current firm revenue on the pipeline. Maybe your goal is 7% or 15%. Set a goal and make sure on your calls you're talking about them. And your win rate, you know, we talked about them being between 60 and 70%. You know, maybe you're going to start out by trying to move yours up to 55. Whatever it is, set that goal and then use it. And then remember to save your pipeline history if you want to do some further analysis down the road. Now, win-loss reviews are important as well. So this is a way to improve what it is that you're doing. And so what happens with a win-loss review is where you want to sit down and get feedback on how you did, either when you win or how you lose, or when you lost. Now, people, if you go directly to the prospect, they don't always open up and tell you everything that really was an issue. If you can outsource this function, sometimes you get a little more truthfulness and a little more honesty. But you really want to even, you don't want to accept an answer at face value. So for example, if you won based on price, why? What was it based on price? And I think my favorite one that I heard one time is because the other firm's team seemed to mesh with the bookkeeper better than our team meshed with the bookkeeper. And really that just opened up more questions for me, like, you know, did the bookkeeper not like any of our people? Did we ruffle the bookkeeper's feather? Did we even understand that the bookkeeper was going to influence this decision? So dig deeper as you're trying to find this, and don't accept that first answer at face value. And I would say that would include your team members as well. Anyone who worked on the team, dig deeper with them as well. There are two sides to the win-loss review. Is the internal, and that's where you talk about it with your team. And then there's the external, and this is where you actually talk to the clients. Really the focus is on how can we improve for the next time. A common thing that happens when you review a client is, you know, you get the email back that says, oh, you lost, or if you're lucky, you get a phone call saying you lost. And you turn around and go, you know, can I ask why? Or you shoot an email back. You know, that's where I'm saying you can't take this at face value. And if you're one of those people that said, okay, what do I even ask? I have a few sample questions on here to actually get you started. with the prospect in terms of what do you talk about. And so we're going to go ahead and jump right into the next poll question, Colin.
All right, the poll question is live, so I'll leave that open for about 20 seconds. All right, just a couple more seconds there. Make sure you vote. And I'm going to go ahead and close the poll question.
Okay, I kind of breezed through the win-loss reviews a little bit because I wanted to make sure we had time to talk about the role of the proposal in the pursuit process. You know, there is a stage on your pipeline that's called proposal. So proposal is an instrumental part of this, but even though you use the proposal at the end of the sales process, you really have to think about it early on from that very first meeting with your prospects. So that's because a proposal is a recap of what you learned in the sales process. This is where you get to share, hey, here's all the cool stuff we discussed, here's all the issues we uncovered, and here's how we can help you solve all your problems. And we put a lot of effort into putting our proposals together and giving them to the clients according to their timelines, according to their RFPs. But recognize that, you know, prospects are using this in a way that that we may not consider. So, for example, sometimes, unfortunately, they view this as a beauty pageant. And you could come in and you think you have this deal sold. And when they really look at your proposal compared to someone else's, you know, they're like, wow, it's not as sophisticated, or it's not as intensive, or maybe it's not as simple as somebody else's, whatever their decisions are. So recognize that you have to pay attention to what your proposal looks like as well. You also see people using proposals to differentiate firms. So yes, that could be on the look or the design of it, but it's also on other criteria. So how closely did you follow the RFP? You know, what's the quality of the team that we'll be working with? And what other metric they end up putting on some sort of spreadsheet that they judge all of these proposals on. And no matter how unfair we think that is, it's our reality. That's sometimes how these decisions are made. The best proposals are the ones that are all about the prospect. You know, are you in your proposals talking about your client? You're using the word you in your client's name more than you're talking about we, us, and me. When you can demonstrate a deep level of understanding about the prospect, maybe you can uncover an issue that they didn't even know was an issue that no other firm uncovered. That's when you get to show that you're different, and that's what helps you win. Before you get to the actual proposal document, though, you need to ask yourself, am I ready? You know, is that lead qualified? So remember, in simple terms, they have a need now, like today, not in 6 months, and they have the money in their budget to pay for it. You also have to be able to answer a few questions to really help you figure out if it's qualified. You know, for example, I like knowing why they're changing. This really gets to the issues behind the switch. Also, you know, what is motivating the change now? Like, what is it that their current auditor did that made them say we're not going through this process again? Or what just happened in the business that requires this consulting service that you offer? And then also, who's invested in the decision? There are main decision makers and there are influencers. And the more that you can meet with these people and you've met with them, the better information you have to put in the proposal, so you may actually be ready to submit a proposal. So what happens when a lead isn't qualified? So, you know, one option is you don't bid. You know, if you don't have very good odds of winning, and if it's not qualified, you're not going to win. If you don't get the opportunity to meet with the prospect and talk to them about the issues, beside anything that they put in the RFP, you probably aren't going to win. If you haven't built rapport with them, with the decision makers and the key decision makers, they're not invested in you, and so why would they choose you? And if you chase every lead that comes your way, okay, you may win, but you're actually going to have a much lower win rate. So you're spinning your wheels for much smaller results. That's why it's important to understand why a lead isn't qualified and ask yourself if it's worth the effort, knowing that you really have that minimal percentage chance of winning. So in addition to saying no thank you, you could try to buy yourself more time. Maybe you feel like you've met with the CFO, but you haven't met with the CEO of the company yet, and he's on vacation this week, and they want the proposals this week. You know, can you make a case for extending that a little bit so you can talk to the CEO next week? You can buy yourself a little bit of time. It'll help you do the sales work that you need to do. And if they're not willing to give it to you, maybe this tells you something about the type of client that they're going to be, and maybe it's not a type of company you want to work with. So most importantly, the proposal needs to recap the sales process. You want to spell out what you heard the client say. So for example, I remember an instance once where somebody was talking about the fire in his belly and how he really makes decisions and listens to this fire in his belly. And we actually use those words back to him in the proposal. And what this said to him is, oh my gosh, these people really listen to me. They get me. They're talking my language, because literally we were. You also need to not take the first response at face value. So, what is it, that is your biggest issue for switching right now? Well, that's price. We probably hear that on a pretty regular basis. But why is it price? Are they having cash flow problems? Maybe they feel like they weren't getting much from their current CPA. Either of these scenarios would have you responding in completely different ways and presenting a different solution that's really going to get to the heart of why they feel price is an issue. So, when you sit down and respond to price by saying, we're going to be cost effective and we're going to work to be efficient and we're going to pass those savings on to you, your solution sounds generic because it is. If you really understood that they were having cash flow problems, your solution to help them in those areas would be much more valuable to the organization. So when it comes to doing this, you have to first be able to identify the needs of the buyer in the sales process. And you really want to put these at the front of the proposal. First and foremost, because this is really what's going to grab attention. It's probably most likely to be read. I know we really want to think that our proposal, or that our prospects pick up our proposals and read them from cover to cover, but they don't. Chances are maybe they'll read the first page or two, and then they're going to flip to the pricing. Even better, they probably go to the pricing page first and then go back to the beginning and read until they lose interest. So when I say you need to list the needs that you uncovered, this is using those specific words verbatim. So if you're uncomfortable using the fire in your belly, put it in quotes. Also use people's names. So maybe you met with 3 different people at the company, but it was John who said he feels like his accounting department is really understaffed and he's working so many hours a day he can't even think straight. If that was the issue that you heard and John said it, make sure that you say John is, John told us about, his staffing issues. For each need you identify, you want to say how you're going to very specifically address that issue, and it needs to be unique. So go back to John, who's working like crazy. Maybe you want to provide him outsourced help, and that's your solution to him. Or maybe you sell a technology solution that's going to increase his efficiency. Or maybe, you're going to try to help him make the case that he needs to hire a new person to help him. Whatever solution is going to best solve the need of the prospect is what you need to present. And that shows the value that you're bringing to that relationship. There are different categories of questions that you need to ask. I have just a variety of different questions here to kind of get you started. But the one thing that I think is important to note about the question, and any question that you would come up with to ask, is they're open-ended. We're not looking for a yes or a no. We want the prospect to talk after we ask the question. We want to listen and we want to take notes. And if we feel like, what they just said was a bit superficial, ask why. Dig a little bit deeper. And then you want to use these answers in your pursuit strategy. So take notes. If you know and you uncover that Joe is going to be influential to this decision, your next step in the sales process is how the heck do we go meet Joe? Remember, it all comes back to that proverbial radio station, Wii-FM, which is what's in it for me. When you make this about the prospect, you can first demonstrate that you are going to bring value to this relationship. Let's say you have the head of your tax team, and he's a former IRS agent, and he's got some Big Four experience, and he went to the top colleges. Guess what? The prospect doesn't care. What they want to know is, what does this mean to them? So if you have used your tax leader's expertise to negotiate tax savings during an IRS audit, and that's why he's part of this team, you then take those credentials and you translate that into something that matters for the buyer. Another common thing that you hear is, oh, we use technology in our audit. Great. Why? What does this mean for the prospect? Technology probably makes you more efficient, but how does it help me? Make sure you position yourself with the prospect from the perspective of, they reading this and saying, wow, this accountant totally gets me, and they're the best person to help. And many people use a proposal to sell, and proposals do not do the selling. It's used at the end of the sales process. Throughout the process, you've connected and you've built rapport with your prospect. You've helped them see how you can help them solve problems. You've asked insightful questions and really got them thinking about their business. And that's when the proposal document comes into play. When it's done correctly, this is really just a formality. It just, it tallies up everything that you talked about so that they can say they went through the process and they chose you. I like this quote by marketing guru Seth Godin. Sales happen at an emotional level. So even if the prospect thinks he's going to make a decision based on what's written down on a piece of paper, like in your proposal, chances are the prospect's not. It's going to be on that emotional level, on how well they connected with you and how well you understood them. So with that, that wraps up my portion. I'm going to turn it back over to Colin, who I know has just a little bit more information, and then we can stick around for Q&As if you have any, and Tom allows.
Thank you, Katie. I'd like to make a couple of quick announcements. One is that Katie actually will be with us and a couple other speakers at an event we're hosting in early August. So you should see a link on your screen. You can go to that web address and register. We are limiting it to a small group so that we can have a small work session when speakers actually come in and speak with people and have a productive time for basically half a day here in Raleigh, August 2nd. So take a look at that and register. Next quick announcement, we have a recent ebook that we published. We do this every year, at least we've done it the last 2 years so far, and we like to get together with thought leaders from across the industry and look at what they're saying to firms and in situations where they're trying to adopt technology. So this ebook is all about how to think about technology investment. It's not about Sageworks, actually. It's simply about how business advisors and CPAs, accounting firms in general, can think about how to make technology investment, make sure that technology is working for you, you're getting the ROI that you want, you're getting the benefits that you expected from the purchase, and so on. So it's a good way to get your team on the same page with technology and how you could be leveraging it. So take a look at that. There's also a link there. We'll send it around afterward. It's free to download. I'm going to spend just a minute here about Sageworks for those of you who are unfamiliar. I mentioned earlier ProfitSense, our flagship product. It's a financial analysis and advisory solution, so it allows you to look at your client's data, figure out how the business is performing, benchmark those businesses, provide services that are differentiated. So when you're in those prospect meetings and you're trying to turn those prospects into actual clients who are paying you, you can use Sageworks ProfitSense reports on different industries because we have the biggest database of private company financial data, so you can report on their industry, go to them with financial insights in hand, have a productive, useful conversation with that prospect, and help turn them into a client. So it's something that can be useful for client acquisition and also for differentiation as you're thinking about your services. Sageworks Valuation Solution, I'll just spend a quick second on, designed following the AICPA's guidelines, SSVS1, to go through the income, market, and asset approach. All of it is in the cloud, so you have the benefits of cloud technology where it can streamline and automate your process, allowing you to save time, reduce human error, and still provide high-quality valuations and valuation reports through actually a plugin that allows you to use Microsoft Word to generate reports as if you're just doing it normally, but faster and with better insight and data into that company. So something to consider if you're performing business valuation. I like to throw out a couple stats here. I know I'm talking quickly because I want to have some Q&A. And we do have another poll question, just to be clear. We like to share some information that we see in the industry, so we try to change this every few months, but these are some stats we've been sharing lately, and I think it ties into the presentation today. Thinking about the first one, 25 to 40% of new business generated by top CPA firms comes from cross-selling to existing clients. So you could have higher profit margins for your business simply by going back to your existing clients in a smart way and identifying how you could better help them, serve them. Something to consider if you're not doing it already, or if you are doing it, maybe reevaluating it with what Katie shared today around pipeline management. One quick poll question, and we'll dive into the Q&A for anyone who has questions. Just going to launch this for 20 seconds, just like the others. So that should be live. You should be able to see and answer that poll question. Just to be clear, this is an invitation to talk about your firm and what you're looking to accomplish and to see if we can be helpful. We're there to answer questions, to learn more about your objectives, and to see if our solutions can be useful to you in helping you further your agenda, what you're trying to accomplish. And sometimes it's a great fit, and sometimes it's not. So there's no hard feelings. It's simply we call it a discovery conversation. So it's very short, few minutes maximum, just a chance for us to say hello and learn a little bit more about what you're looking to do. And if it is useful, we can go into the product at that point and actually show you all the features and functionality of any of our products. But this initial call is simply just to see if we can be helpful to you in any way. All right, looks like we are actually over on time. Sorry about that. Go ahead and close that poll question. Right, and let's get to Q&A. I will take a look at the questions here. Okay, we have a couple of tactical questions on pipeline management. One is specifically, if you're thinking about qualified leads, when you're looking at business that you've won or lost, is that only thinking about qualified leads, or is it possible that maybe there are other definitions of leads that would be considered as won or lost business?
A winner or loss is anything that you bid on. I would hope that those are all qualified leads, but unfortunately I've seen where you choose to bid on a lead that's not qualified that results in a win or loss. So anything where you submit a proposal, you submit an engagement letter, you send a price in an email, however you communicate that, and you get a yes or a no, that would count as a win or a loss, as long as it meets whatever that minimum dollar threshold is that you have for your pipeline.
Okay, that makes sense. And here's another one. In your experience, have you by chance seen CRM software that has these types of reports or functionality for managing pipeline?
Virtually all CRM has a pipeline component. What I found with some of the CRM solutions is you need to find the one that you can use with the least number of personalization edits needed. So I was at a firm and we were using Microsoft Dynamics, and we wanted to do a bunch of customization. And what I learned throughout there is anytime I customized it, an update came through, it could blow up all my customization, and I would have to budget additional dollars down the road to fix them. So I decided not to customize. But what I would say is, as you look at a CRM solution, find the one that you think out of the box works the best for you for pipeline management. But CRM, by definition, should all have some sort of pipeline management tool.
All right, thank you. That looks like one other question here that we have time for. And we're a little bit over, so thank you for staying with us. So this question is, what is the recommended way to track the time from a billable team members seeking a lead or prospect? So if those billable team members are out there trying to convert those leads into actual clients, is there any sort of best practice around how to track their time?
So I just actually had a firm ask me about this not too long ago. And my response back to that question is, what are you going to do with the track data? So you could easily put a code in your time and billing system for opportunity pursuit. But what does that mean? For me, maybe some opportunities you can close with an hour and a half investment, and others are going to take 7, 8, 9 hours of investment. So I guess I would question why you're tracking it and what you're going to do, and is time the best way to track it? Is it more the number of leads they have, the size of the leads they have? I would just say yes, you could build out a code within your time and billing system and do it, but it's not worth the effort if you're not going to use it to somehow manage the process.
That's a great answer. Thank you for that. Well, I know we're a little bit over here, and we do appreciate you, Katie, taking the time, as well as everyone who joined us today. Again, we will send around the information from today's presentation, as well as more information on the event and the ebook in an email after this in the next day or so. So look for that in your inboxes. And thank you all for being here. We really appreciate it.